If you've ever wondered whether it's possible to build wealth without getting stressed out by constant stock market volatility, then today's video is exactly what you need. What if I told you that there are ETFs designed specifically to reduce risk, smooth out big market swings, and still deliver strong long-term income? Yes, they exist. And in this video, we're breaking down the 7 best stress-free, high-income, low-volatility ETFs that long-term investors can rely on. These are funds built for people who want to grow their money, sleep peacefully, and avoid the drama that comes with high-beta, speculative investments. So stay with me until the end because ETF number 7 is a fan favorite among defensive investors and could be the most reliable long-term income generator of them all. Welcome back to Stock Predictor. Let's get into it. Before diving into the list, let's understand why low-volatility ETFs matter so much right now. The market has been going through rapid rotations, inflation pressures, interest rate uncertainty, and unpredictable earnings cycles. For most investors, that means a stressful experience. Your portfolio rises one day and crashes the next. Low-volatility ETFs help solve this problem. They focus on companies with strong balance sheets, stable earnings, and historical price stability. Combine that with high-income strategies like dividends or covered calls, and you get something powerful: steady income, smoother returns, and less headache. That's why these ETFs have become extremely popular among long-term investors who prefer consistency over chaos. Now let's start with our first ETF on the list. ETF number 1 is the Invesco S&P 500 Low Volatility ETF, ticker SPLV. This fund is incredibly straightforward. It simply picks the 100 least volatile stocks from the S&P 500. No fancy strategies, no complicated filters. Because of that, SPLV offers a smoother ride compared to the broader market and tends to hold defensive sectors like utilities, consumer staples, and healthcare. Income investors appreciate that SPLV typically offers a stronger yield than the overall index. It's ideal for anyone who wants to stay in the S&P 500 but reduce risk dramatically. If you struggle with the emotional pain of big market drops, SPLV can help keep your portfolio calm. The second ETF is the iShares MSCI USA Min Volume Factor ETF, ticker USMV. This one is more advanced than SPLV because it uses optimization models to build a portfolio with the lowest possible volatility while maintaining diversification. That means instead of just picking the calmest stocks, it constructs a balanced system designed to reduce drawdowns. USMV has historically outperformed during market crashes and major pullbacks, making it a favorite of conservative investors. The dividend yield is modest, but the real income advantage comes from limiting losses. When you lose less in bad markets, you gain more long-term. Investors often underestimate this simple mathematical truth. Avoiding downside is one of the most powerful income strategies. ETF number 3 is perfect for investors who want both low risk and higher income. The JP Morgan Equity Premium Income ETF, ticker JEPI. This ETF exploded in popularity for a reason. JEPI combines high-quality, low-volatility U.S. stocks with a covered call strategy that generates large monthly distributions. It usually pays between 7% and 10% annually, depending on market conditions. The trade-off is that JEPI gives up some upside when the market rallies sharply, but for stress-free investors, that's usually a fair exchange. What makes JEPI special is that it manages volatility extremely well while creating reliable monthly income. If you want cash flow without taking aggressive risks, JEPI is one of the best ETFs available today. ETF number 4 is the Schwab US Dividend Equity ETF, ticker SCHD. You might be wondering why SCHD appears on a low-volatility list. The answer: SCHD focuses on high-quality, low-debt, consistently profitable dividend-paying companies. These kinds of companies naturally have lower volatility because they're stable, mature, and financially strong. SCHD has a history of outperforming the market with lower risk and higher dividend growth. Its holdings include blue-chip companies with reliable earnings and strong free cash flow. For long-term investors, SCHD offers a powerful combination: low volatility, strong dividend income, and excellent long-term performance. It's one of the most trusted ETFs in the dividend community. ETF number 5 is the iShares Select Dividend ETF, ticker DVY. This fund focuses on high dividend, low-volatility companies across the U.S. market. What makes DVY unique is its weighting toward utilities and other defensive sectors that have historically shown strong stability. Investors who want reliable quarterly income without worrying about big price swings often choose DVY. It's not as huge or popular as SCHD, but it fills a valuable niche: dependable income from companies that rarely experience extreme volatility. If your goal is to build a safe income foundation, DVY deserves a spot on your watchlist. ETF number 6 is designed specifically for retirees and conservative investors. The Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD. Think of SPHD as a hybrid of SPLV and high-yield dividend strategies. It selects 50 stocks from the S&P 500 that offer the highest dividends but also show the lowest volatility. SPHD typically offers a high monthly dividend yield and is known for its defensive structure. This ETF shines during market downturns because it prioritizes stable income-producing companies. If you want both high yield and lower turbulence, SPHD is one of the best income ETFs available today. And that brings us to ETF number 7, the star of the low volatility world, the Global X Super Dividend US ETF, ticker DIV. This ETF is specifically engineered to deliver extremely high monthly income. It screens for low volatility, high-yield U.S. companies and spreads them across multiple defensive sectors. DIV typically pays one of the highest yields among low-volatility ETFs. But there's a catch: the companies it holds are often slow growth or mature businesses. The good news is that the low-volatility filter helps avoid riskier high-yield traps. For investors who need monthly cash flow and reduced volatility, DIV offers one of the most generous income streams on the market. It's not a growth ETF, but it's a favorite among investors who want reliable payouts every single month. Let's now talk briefly about how to build a stress-free portfolio using these ETFs. One of the biggest mistakes investors make is putting all their money into just one ETF. While each of the 7 ETFs can perform well individually, combining them strategically can create a smoother portfolio with more stable income. For example, JEPI can provide high monthly cash flow. SCHD can deliver long-term dividend growth. SPLV or USMV can stabilize market volatility. SPHD or DVY can add defensive high-yield exposure. DIV can provide additional monthly income. When blended together, this creates a powerful income machine that is diversified, defensive, and long-term oriented. Another important point is understanding the trade-offs. Low volatility ETFs tend to underperform slightly during strong bull markets. They are not designed to chase massive growth. Instead, they are built to protect your wealth during downturns and deliver steady, predictable returns over the long run. Many investors underestimate how important stability is. When your portfolio doesn't crash during market panics, you don't panic sell. And when you don't panic sell, you make more money long-term. Low volatility strategies are built on psychology as much as mathematics. They keep your emotions stable, and that alone can make you a far more successful investor. Let's also touch on volatility risk, something most new investors ignore. Volatility is not just about price movement, it affects your behavior, your decisions, and ultimately your results. A highly volatile portfolio leads to emotional decision-making. A smoother, more stable portfolio helps you stay invested. Staying invested is the #1 secret to building wealth. These ETFs help you do exactly that. Before we wrap up, let's quickly recap the 7 stress-free high-income ETFs on our list. SPLV, low volatility from the S&P 500. USMV, advanced low volatility optimization. JEPI, high monthly income with controlled volatility. SCHD, high-quality dividend growth with naturally low volatility. DVY, stable dividend income from defensive companies. SPHD, high dividend plus low volatility combined. DIV, ultra-high monthly income with a stability screen. Each of these ETFs serves a different purpose, but all of them share the same core value: reducing stress while delivering strong long-term performance. If your goal is to invest for the future without dealing with unpredictable market swings, these ETFs can help you build a portfolio you can rely on. Investing doesn't have to feel like a roller coaster. With the right strategies and the right ETFs, you can grow your wealth calmly, consistently, and confidently. Thank you for watching Stock Predictor. If you found this video helpful, make sure to like, subscribe, and let me know in the comments which ETF you want me to review next. Stay smart, stay disciplined, and I'll see you in the next video.